Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Reality radio for a really great future. We're talking real money.
Money and investing both boil down to one pretty simple thing. Consumers. Consumers are the ultimate drivers of most of the economy. Sure, there are a few things in which consumers are not immediately involved. Defense spending. Not many of us go out and buy tanks or Stinger missiles.
I'm more into planes, as you know. So yeah,
but yours are all plastic. They won't fly very far,
and they won't do well in combat either.
Consumer spending really does drive economic growth, and economic growth drives the values of many, if not most, investments. But the thing that really drives it all is a thing called sentiment, and that is how we feel about the situation and our ability to spend and consume and enjoy and do things. And right now, with all of the confusion and uncertainty about tariffs, be they 10% or 150%, people are reacting to those things.
Yeah, and they're not feeling very good about them. Let's just put it that way. In fact, a new poll finds that 85%, by the way, when we're talking about consumers, yeah, we're talking about you. It's just some other group of people.
And we're talking about American consumers,
That's
too.
a good point.
Because, I'm talking about Chinese consumers. They're very different than we are.
Yeah, they didn't get polled either.
I haven't met any of them.
No, well, maybe not. But here's the thing. 85% of us have concerns about the tariffs and are looking at our spending, are looking at our plans. And what does that mean? Well, that might mean trouble ahead for companies, right? Where people are going to spend less. Now, fascinatingly enough, do you know that the number of people searching global recession or economic meltdown is the highest it's been since 2020? They're typing that in on the internet. They're like, oh, I better look into this, see what that's going to mean.
We're trying to understand what it means.
Yeah,
what it's going to mean to each of us in our day-to-day lives. I have heard people say things like, well, I've heard a lot of the R word, recession, but I've even heard the D word, depression, crop up now and again, and there's a legitimate fear of that. And that can become a self-fulfilling prophecy.
That's the point.
Consumers react to those feelings of uncertainty or that fear about the future.
Yeah, and in fact, the people that trade, the people that are buying and selling stocks, you're hearing more now about them, like watching the number of ships that are coming into Long Beach and how much shopping's going on at Walmart, and starting to really analyze, getting down to the nitty-gritty to see what this is all going to mean.
Well, and you can look back at the past to get an idea. During the trade battle we had in 2018, 2019 between us and China, Walmart and Target both reported dramatically different buying patterns on the part of their consumers because they track everything. And they found that we would buy essential goods, but we wouldn't buy luxury goods or non-essential items, electronics, appliances, that kind of stuff. We bought food, we bought medicines, and we looked for, and we would buy things that were on sale. If they weren't on sale, we weren't buying them.
Yeah. So accepting all of that, and sentiment, by the way, what did they say? It's down like 30% since December. That's pretty steep. That's a pretty big decline in how people see the future. The question then becomes, what should you do about it with your money? I really think there's only one thing. Because we're not going to tell you to sell stocks and buy bonds. We're not going to tell you to go buy gold. We're not going to tell you to time the market or do any of those things. But here's something I think you probably should do, no matter what age you are. You should probably have a healthy amount set aside in a thing called emergency savings, right? Mm-hmm. This is the money set aside. It's not invested in stocks or bonds. It's in, could be high yield savings, could be money market, but it's available should something go wrong and you need cash.
And let me just add, we are not fans of any kind of market timing, but this may be a good thing to start saving into. Not really selling anything and buying into emergency savings, but those emergency savings, if you increase them by adding more money, you can make yourself feel more secure.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan, one that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Our phone number is 855-935-TALK, 855-935-8255 every Saturday, noon to 2 Pacific time, 3 to 5 Eastern. Call us then. You notice that if you listen to the last hour or the last podcast, you notice the calls came in from all over the country. That's because we have podcast listeners all over the country. But we're live in Seattle on Saturdays, so give us a call, 855-935-TALK, 855-935-8255. I'm Don McDonald, along with Tom Cock, and we're talking about how we might react to tariffs and how we have been reacting to tariffs. It's been only a few months since we've really had all this tariff uncertainty, but let me give you a couple of examples. One, on May 3rd, there's supposed to be a 25% tariff on fully assembled automobiles scheduled for May 3rd. In the past month, well, actually in March 2025, motor vehicle sales and motor vehicle parts sales grew 8.8% year over year as people are stockpiling automobiles and automobile parts.
That's fascinating to me. Now, I'm not in the market for either, so I don't really need to stock. Like when you say parts, though, what, like oil change kits or something? I mean, I don't understand what that means.
Like alternators or tires. Where are most tires made? Overseas.
So do you have 4 extra sitting in your garage now?
I don't stock up on things. And by the way, one of the things, 70% of U.S. adults believe that tariffs are going to lead to higher prices on essentials, and 26% of Americans are now, just this year, engaging in stockpiling behavior.
So we're going to do the toilet paper thing like we did in the spring of 2020?
Food and household items. Now, okay. I want to put everyone's mind at ease on the toilet paper thing.
Oh,
okay.
Okay, good.
Because we're already seeing a shift to domestic products that people they're not buying imported, they're buying more domestic.
Stick with the 2-ply,
99% of toilet paper is made in the United States of America.
So the prices there will not be affected.
So wipe those stress beads off your forehead.
That's one foul-smelling prediction. Okay,
it's funny. Yeah. It's funny though. Already, Amazon's reported that there've been huge increases on hundreds of their top-selling items.
Like
a 29% increase. Apparel, which come from overseas, electronics items. the kinds of things that are built in China or Vietnam or
so
wherever.
Maybe this is all employed to get the economy going a little faster, get people opening up their checkbooks more to spend money,
Wait a minute.
right?
If the price goes up, don't people spend less? What school of economics did you go to?
Not a good one, apparently.
Apparently, it wasn't the best.
Or I wasn't paying attention that day. So
Are you? Yeah.
All right.
Yeah.
Fair enough.
You didn't go to Wharton, for sure. Apparently,
Yeah, don't go there. Okay, let's leave it at that. So,
and then finally, we're seeing less brand loyalty. People are switching brands just to get whatever is cheap. So already behavior is shifting dramatically, and we don't even really know what we're getting.
But let's take that to the investment side just for a moment, because I know it comes up a lot. It came up. We just had a meeting, I think it was Wednesday, with some clients, and they were shocked when they found out their portfolio of 60% in stocks, globally diversified, 40% in bonds, was down 0.5% for the year. They're like, what? Because look at the headlines. It looks like the world's coming to an end.
But that's because we saw such extraordinarily, and it was very unique, market volatility. We saw this massive volatility from day to day. You'd have a day where the market lost almost 10%.
Yep.
And then a day when it gains back most of those losses.
Yep.
And then the next day it loses 5 again. And then the next day it gains back 5 again. Which is why we're at a net, basically, zero return for the year.
People, the headlines, because we get scared more than we get happy, people tend to focus on that side of it. So they were stunned.
Well, and remember that when you own a diversified portfolio of stocks, you own those businesses that will do well because of tariffs and those that will be hurt by tariffs. There will always be companies on both sides of that spectrum. If you have bonds in your portfolio and we get into a recessionary environment, those bonds will fluctuate less because they're going to be considered a safer haven than equities, and more buying will, or has at least in the past, taken place in those types of securities. So the key to making all of this work as an investor is making sure the plan was already in place.
It shouldn't be putting together as this happens. So you have the plan, you have the asset allocation, you're rebalancing because you have a disciplined approach, and the rest of it is noise.
Right. And as we have said over and over again, the only proactive thing you should be doing right now, and it's purely for psychological reasons, is gradually increase your emergency funds.
I think that's smart. Yeah.
Because it feels like insurance. And the nice thing about it is, as opposed to these hedging strategies, these
buffer
funds and the like, which charge you a fortune for giving you something that feels like insurance, an emergency fund is a insurance policy that really doesn't cost you much. And if you invest it right, it can make you a couple of bucks along the way.
Well, that's the other thing, that the cash is actually paying something today, whether it be the money market, whether it be the high yield savings. Lots of options there that are still returning somewhere around that 4% mark. That's not bad on your, liquid assets.
Yeah. So don't let the bad news drag you down, because one reality, and this is mainly for you folks who are younger.
Where's the line drawn, just so I know, by the way?
I don't know where that line is. It really depends
on
your mental attitude. It is definitely way below us.
I'm sorry to say.
Me too. Way below us. Although I have to tell you, I watched Amazing Race with Debbie the other day, it's just good old clean. When we don't want to be stressed out, she doesn't like shows sometimes that are
make
really
you nervous. Yeah, I get it. Sure. Yeah.
Or a lot of blood and things.
Yeah, sure.
So we watched that, and there was they went to Bulgaria, outside of Sofia, Bulgaria. You know where Bulgaria is?
I do.
You actually know geography. Some people are like,
I've not been, but I do know where it is. Yes.
Who goes to Bulgaria?
I don't know.
I mean, come on. You might go to Turkey, which is right next door
That's
or
true.
Greece, which is next door.
I have been to Greece.
Or maybe even Hungary, which is Romania.
I
is next
never
door.
go there on an empty stomach, but I could go there. Sure.
But you can go there hungry.
Yeah. Okay.
Go there hungry. Anyway, there was this woman in the scene who was 102 years old, and I went, and she was spry. She was eating Bulgarian yogurt, so maybe that's the key.
That is the key.
Stick around for a while. You know what Bulgarian yogurt's made from?
I probably don't want to know.
No, it's not that bad.
Oh, okay.
Their yogurt's made from sheep milk.
Sure. Why not? Yeah.
Yeah, it's not bad.
Yeah. Goat milk, sheep milk. What the heck? Yeah, why not? Sure. 102 though. That's a lot of birthdays.
102. You know, I'm hoping for another 10 or 12.
Yeah, that's about what I'm hoping for.
102 would get me it'd be like having another life yet to live.
Now, I'm going to throw this in. Yeah, go ahead.
What?
Quick.
Go ahead.
Well,
No,
I was going to just say happy birthday to my son today, who would have been 35. Want to learn more? You can go to my LinkedIn account and find out more. So happy birthday,
855-935-TALK is our phone number. 855-935-8255. Give us a call.
Tom and Don are talking real money.
That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
For your real life and real future, Tom and Don are talking real money.
What is wrong with our world? I got a news update in my email account from one of the papers I subscribe to. Listen to the headline. Well, this is a synopsis of it. Pope Francis funeral and where Shedeur Sanders landed.
Shouldn't it be the other way around?
Pope funeral and Shedeur.
Where did the Pope end up landing?
Why do
Sanders is.
I mean, I enjoy watching football, but I just
don't
care where Shedeur Sanders landed or any other.
By the
NFL
way, for those of you hanging on that, he landed with the Cleveland Browns. So don't they already have a quarterback that's kind of controversial?
They got 6 or 7 now. They're just trying to figure. They're going to play musical quarterback chairs. They just play a little
first
bit.
Down. I'll take second.
Cleveland fight song and a bunch of cheers. 855-935-TALK is our phone number. Let's go down to the great state of Texas. And Jim, welcome to the program.
Hey guys, enjoy your show. Been listening for some time. Funny you mentioned the lady in Bulgaria. That's part of the reason for my call. In addition to managing my own money, I manage my mother's, who turned 102 last month.
Wow. In Bulgaria?
Wait, and she's the one with the yogurt?
Not in Bulgaria.
Oh, okay.
Okay, now I was getting worried there for a minute, Jim.
Yeah.
Okay.
No Bulgarian yogurt. I think just, I don't know.
Just plain old American yogurt.
What she would say.
Try applesauce or something. It's easier. So, yeah.
Could be. Yeah.
Texas yogurt. That comes from Longhorns.
Oh, God.
Well, she's in Ohio. So,
well, then that's Buckeye yogurt.
There you go. So, she has the good fortune of being in a high tax bracket and, income from various sources that, is sort of, it's hard to divert unless she just gives it away, right?
That's right.
So I've been doing the numbers, and it seems like a municipal bond fund would work better for her than her current bond funds that she's in. And I've looked at VTEB and VTES, and I'm just wondering if you guys have a recommendation for a good municipal bond fund. Again, just for the stability side, she's about 40% in equities, 60% in bonds.
Okay, but go back. What is her recommendation I got to stop you for a second. What is her marginal rate? Because it has to be pretty high to be really the person that uses.
No, it really doesn't have to be that high.
24 plus.
If it's over 24, you're getting there. It has to be
24. So is she?
Yeah, I mean, her taxable. Well, the only thing she has is her standard deduction, which she's single now. She's widowed. Mm-hmm. So her taxable income last year was probably like $275,000.
Wow. Okay.
So she's high bracket with no deductions.
Yeah.
She's high bracket. I would go. I love VTEB.
It's a great fund. Yeah.
I really like VTEB because of its massive diversification. It still has a middle of the road duration of about 7 years. It's a little long, which does mean a little bit more volatility than VTES.
And what's the yield?
The yield is much higher. The yield is 3.85.
Yeah,
The SEC yield is 3.85 versus like 3.1 for VTES.
And you're getting that tax-free, so that's kind of a nice deal. Yeah, sure.
And the volatility has not historically been very high. I mean, its worst year ever, get this, ever was 2022. What would you guess a bond fund lost in 2022, Tom?
Well, I mean,
You're gonna be
I think
shocked.
the total bond lost like 12, so on this one I'll say 8.
8 is dead on right.
Well,
and
how
that's
about
it.
that, huh?
That's as bad as it's gotten. And that's just not enough to worry about.
What do you think about states? What do you think about state-specific bond,
Not in Ohio.
municipal bond funds?
Not in Ohio.
Yeah.
You're not going to find much, and you're going to pay through the nose to get it.
That's the other problem when
She
you
has
try
a
to
couple
buy
from
those.
an old broker, and I've
Yeah.
no,
No, those
an old
old-
broker of hers put her in a couple, and I've looked at them, and they're Van Eck, and there's some expensive things. And
They're
I- you know,
ridiculously
so-
expensive, and the risk is much, much higher.
As it
because
has to be.
It has to be because they don't have a lot of issues from which to choose. The only 2 states that have a reasonable supply of low-cost double tax funds are California and New York. That's it.
And those are worth buying because of the taxation there, so sure.
But not in Ohio.
No.
Okay.
No.
All right?
Okay. All right, good. I'm going with VTEB then. And the only thing
All right.
I'm stockpiling here in Greater Houston is rainwater for my flowers. So I'm not stockpiling anything else. Okay.
How about energy for your air conditioning for the next 5 months too?
I'm going to go.
Well, my mom's she's getting oil and gas royalties, so we're long on energy already.
He's long energy. I want to go long Buckeyes though because she lives so long. But I got to figure out how to milk a Buckeye. How to milk a Buckeye? 855-935-DON.
Tom and Don are talking real money.
You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Stay tuned for an important health announcement from Talking Real Money. Do not eat Buckeyes. They are poisonous. Do not milk a Buckeye. Do not chew a Buckeye. However, if you want to keep one in your pocket, that could be why Jim's mom has lived so long.
Or is
She
it just
probably has a Buckeye in her pocket? No, in old country, the belief is that if you keep a Buckeye in your pocket, it wards off rheumatism or arthritis. It cures headaches, or you can rub it to your forehead. If you have one in your pocket too, not only will you not get rheumatism, you will not be bitten by snake. No snake bite. And it will give you energy, prosperity, and good luck and long health. The power of the Buckeye.
Yeah, I'm just thinking of all the other things I could put in my pocket that might do the same. So I'm going to leave it at that.
You're not going to go get a Buckeye, huh?
I guess not.
Oh, and the other thing Buckeyes can do, I read online during the break, was that if you drill a little hole in them and string them together into a necklace, they can make you very rich at Ohio Stadium if you stand outside selling them.
Isn't that what they put on the back of their helmets at Ohio State
Buckeyes.
University?
Yeah, they put little sticky buck. But I'm telling you, they just sell real ones. I mean, they're in the fields. 855-935-TALK is our phone number. Let's go to Auburn, Washington now. And Steve, it's your turn. Welcome to the show.
Hi, thank you. Hey, I appreciate you guys' podcasts and your common sense help, and especially
facts about
I appreciate
Buckeyes.
You putting everybody's. Yeah, I appreciate your comment. I appreciate putting everybody's mind at ease about toilet paper also. So hopefully you don't have any runs on that.
No runs on the toilet paper? Okay. That sounds like one of Tom's bad jokes, but okay.
Joke.
All right.
All right, go ahead.
Hey, my question is regarding doing rollovers from traditional to Roth IRAs. And so I retired about 3 years ago, and in that time, I've gone up to the 22% marginal tax rate, no higher. and rolling over. We've been able to pay the taxes out of our taxable accounts. And that comes to my question. So we are now planning, because of family, to relocate from Washington with no income tax to Montana in the next year or two. And so I was wondering, would it be advisable for us to do a rollover up to the top of the 24% tax rate? But that would require taking money out of the IRA to pay those taxes, which my understanding from listening to you guys in the past, that's not your preference. But I didn't know if this would be an exception because our income taxes will go up 6%. And
wait,
we want to make sure we get the terminology.
More than 6. They're going to go up to 6.75 in Montana.
And when you say roll, what we wanted, the terminology we'd prefer to use would be conversion, because you're converting pre-tax money to post-tax money. That's what you're talking about here. And and how old are you?
Yes. I'm 63.
So you have 10 years until you have to start taking that out. So you have a long time until you're going to be required to move the money.
Right.
Personally, it's so hard. I mean, because you're going to have 10 years of growth of the tax-free, et cetera, et cetera. So there's all that. Here's the thing. To make these decisions on the back of an envelope is a bad decision, because I've looked at this from many, many, many directions. Don correctly pointed out last hour, we don't know what the tax rate's going to be when you have to start taking that money out. No idea. Mm-hmm. I personally would never want to pay the money out of the money that I've already paid the tax. No. It just doesn't make sense to me.
Because it's it not only does it cost you the taxes, but it takes away all of that future growth and that tax advantage growth. And the other thing is I don't know if you thought about this, but did anybody tell you it's flipping cold there?
Yeah. I made the mistake of my son and daughter both went to college in Bozeman, and then they stayed, and now I got grandkids. So I guess I might have to endure the cold if I want to see the grandkids. So. All
right. I'm just thinking, it may be by the time you're facing mandatory, the required minimum distributions, you may be out of there. You may just be going, I'm going to be 6 months and a day in Florida.
Yeah, exactly. That one day. So here's the thing. I'd still do the conversion if that's part of your plan up to that 22, pay the tax, but I wouldn't go over it if I had to take the money out of the IRA the 401k.
The old bird in the hand versus the bush, and we don't know how bad that bush is going to look after a really hard winter in Montana. 855-935-TALK is our phone number, 855-935-8255. Look at that. We have another line open for you, and so darn much time.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan, one that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Oh, my gosh. Tax rates just fluctuate like that. That's why it's so hard to pin them down. Turns out 6.75 was the 2024 max rate in Montana.
Yeah.
2025, it's 5.9. 2026, it's 5.65.
They're cutting
2027,
taxes.
It's 5.4. So,
but he's going to be paying that on top of the 22. So then you're looking at this is the other part. Giving away a third of your money to make that move. I don't know that that's a good idea.
Well, no. He's talking about giving away only 22% now.
Well, no, but you got to before he moves to Montana. Correct.
Right, before he moves to Montana.
Yeah.
And I'm just saying, before you get to the RMD, he's going to be in Arizona or Florida part of the year. So,
and this is the thing, though, about the Roth conversion. I personally see it many times. I think it's overused. It's simplified, and it's like, this is going to be so simple. I'm going to have all this money in post-tax. Yeah, but you're breaking that old rule that the CPAs always used to say, and that is pay no tax before it's time. So it ain't that simple.
And don't move to a place where you can freeze to death in the car. We
both
saw 1923.
Yes, we did. No, that's true. And by the way, I played a soccer game once in Missoula in November that was the coldest game I'd ever been in. They actually brought the vans to the side of the field so that when you subbed out, you could go in the van with the heater on.
Until they run out of gas, and then you freeze to death in the van.
It's bad. They cut your toes off. Yeah,
855-935-TALK. That's our phone number. Let's go to Seattle. Martin, your turn. Welcome to our program.
Hi, I love you guys' show. Just wanted to ask a quick question on your opinion on those fixed index annuities. I went to one of those dinner things and just want to see what your take is on those.
How was the steak?
The steak was really good, but I just a lot of information, but they don't give you enough information. They want to book a second meeting, but
second
your
meeting.
Opinion.
You said no, I hope, didn't you?
No, are you having a second meeting? And if so, can we come with you?
No.
Oh, yeah.
Okay. No, I did not book a second meeting, but I did some research online, but I wanted to know what your take is on those.
Well, I got to tell you, the last one of those I went to, I nearly got thrown out. Because I nearly got thrown out and probably divorced. Because all I did was ask some pretty normal questions.
Pointed questions?
Like, well, one, what's your commission?
Oh, we don't get a commission, sir. The company pays us.
Tom knew the answer. Look at that.
I should be selling these things.
And I said, how can you afford to give someone with the return of the market with none of the risk? What magical investment are you putting that money in?
Well, we can't tell you that. But.
Yeah, we have a strategy that uses the. I'm going, no, you don't. You don't. Here's the deal. It's a great sounding pitch. And that's as far as it goes because it is all based on. It's. I hate to use the word lies, but if we broadly apply lie to obfuscation,
misleading,
misstatements, twisting the facts. I bet they showed you a chart that showed how bad the stock market did during certain times, and how you, if you had this index annuity, would not have lost money during those periods, right?
Yes.
Yes. That chart was of the market without dividends,
which make up. Oh, no, you could use 2 as a rough number, percent or so. Yeah.
It was enough to take out most of those losing periods they showed on that chart. If you got the dividends, you would have been okay. You wouldn't have lost money. The other thing they don't tell you is that their indexes are really weird. They use these made-up indexes that their actuarial people have crunched the numbers on and said there's little or no chance that these indexes can go crazy. But to make sure that that doesn't happen, then they have a cap on what amount of that market you can make. And they have what's called a participation rate, which is what percentage of that market's return you get to make.
Yeah, you wrote a great paper on this. It might have been 10 years ago now.
It was 10 years ago.
And I know they're still selling like hotcakes because every time the market goes down a bit, everybody said, "Whoa, we're going to do something because I don't want to see my net worth decline." So they're sold a lot.
And that article, by the way, is still up at talkingrealmoney.com.
Oh, okay. I was wondering because
you
that
can
was
find that article.
But those two things you just
annuities.
mentioned is if you understand them, would you use them? The participation rate and the market the capping of your returns. They're so complicated. And when you ran the number, if I remember correctly, Don, you looked at like 10 years and you made about half of what the market had performed. It was something that not even close to market-like returns.
No, as a matter of fact, I'm pulling it up right now. The average return for indexed annuities between 2007 and 2012, that's the data I have right here, was 3.27%. Does that sound like the return of the market?
That sounds like more like a third of it. Yeah. So, it's Misleading, you're right. Partial information. It's all those
things. And they
things.
also use, I forgot the other thing they use. They use what is called a month-to-month crediting method.
That's right, yeah.
Which is not the total return of the market. It's how it did from one day in 1 month to 1 day the next month, and then they reset that. So it's all a big gimmick.
We don't believe in magic, and especially magic when it comes to money.
And yet, you know what the commissions can be?
Speaking of magic.
10%.
Think how incentivized the person sitting across from the table from you is to get you to sign that, because, wow, that could, on a $100,000 annuity, figure that's $10K for an afternoon of work. That's pretty good payout.
Does that answer your questions?
Thank you for your time. Appreciate it.
You are very welcome. In other words, we hate them. The average commissions, by the way, there are low commission indexed annuities. The lowest we could find is 3%. The typical is 7, 8, 9, and there have been some at 10. And the surrender charges, we saw one. Didn't we see a surrender charge once that was like 12%?
Yeah, I think we saw 12 at one point. A long time ago. But
I truly just hate these products, and I really, therefore, have to despise the people who sell them, because they are a bunch of liars. Either they're stupid or they're crooked. They got to be one or the other.
Or they don't understand the product any better than the people.
Then they're stupid.
Or they're just because
dumb.
They told me they're okay.
Can I say dumb? They're too dumb to look.
Didn't you used to sell mutual funds with an 8% load on them or something?
And I was
like
a dumb bunny. I will tell you, I was stupid for selling
I'm picking
those.
on you because you mentioned it on the podcast recently.
I will totally admit that I was an idiot for not understanding what the market was doing. I was doing what my firm. I was in my 20s.
Okay, that's
how many of you were
what did you do? You started to say there, and you stopped. I was doing what my company
told me to do,
and this is what they're going to say.
Yeah.
This is the product they gave me. It's a good product. I know it's been researched.
No, it's
it
not.
Works. So
it's not. It hasn't been researched, and it doesn't work because you're an idiot. You didn't look anyway.
Okay.
You didn't. You got to. Salespeople have a responsibility to investigate their products. I failed at that responsibility when I worked for Dean Witter. Yeah. I failed. And I knew I failed. I quit my job. I was with another firm, Betcher and Company, which was bought by Kemper or somebody. I quit my job with Betcher, where I was making 6 figures, to go work at a radio station for literally $500 a month.
How'd that do with your marriage, by the way? Honey, I got a new job.
Shortly thereafter.
I've got a new job. What?
Yeah.
Yeah, well, it's a little less, but
I had to sell ads to trade for groceries.
God.
I did. It was a terrible little grocery store, but hey, I got to eat. 855-935-TALK every Saturday.
Tom and Don are talking real money.
At Capella University, you can learn at your own pace with our FlexPath learning format. Take 1 or 2 courses at a time and complete as many as you can in a 12-week billing session. With FlexPath, you can even finish the bachelor's degree you started in 22 months for $20,000. A different future is closer than you think with Capella University. Learn more at capella.edu. Fastest 25% of students. Cost varies by PACE, transfer credits, and other factors. Fees apply.
For your real life and real future, Tom and Don are talking real money.
After further review, the play on anyway, I found there are really complex fixed indexed annuities, equity indexed annuities, with commissions up to 15%.
Yeah, we're in the right industry, just the wrong part of it. That's all.
855-935-TALK is our number every Saturday, noon to 2 Pacific time. Jim, thanks for calling. Welcome to the show.
Oh, hi. Thanks for taking my call. I do appreciate your honesty and your truthfulness about what can be done without using all these aggressive growth funds. So here's my question to you. I have about probably $1 million in my retirement funds that are with those, what do they call it, Fidelity Target funds?
Target date funds?
30,
Yeah.
30.
Yep. Sure.
Yeah. I have probably half of it in those and half of it in what they call their institutional index.
Okay.
And
which index?
But I parked about, I forget what it's called. It's like the institutional index 500.
Yeah, so that's the S&P 500. Okay. Yep. Right.
Yeah. So I got half and half. I haven't done anything in the last few months. I wish I had listened to your advice in January when you said rebalance it when it was high. I didn't do it. So I've got 240 or so parked right now for retirement funds. And I'm trying to figure out whether I should be putting that into the market now or just waiting. So,
well, here's the thing. Okay, but you're on step 95 when you should be on step 1. Step 1 would say you write the plan, you figure out your income, how much of this money that you've saved you're going to need, what rate of return do you need on that money. Then you move on to the asset allocation, how much in stocks, how much in bonds, how diversified, all those other things. But until you have that plan, you just don't know what happens to that $200,000.
Yeah, so you always have to have a plan. But here's the reality. If you leave it in the account and you wait, what are you waiting for? There will be no bell ring or horn toot. Or no one is going to announce, no white smoke up the chimney that's going to say, now's the time to invest. As a matter of fact, the best time to invest is going to be the time where you feel the worst about the possibilities. You're going to, whatever time it would be the best time is the time when everybody's going, you would be an idiot to put your money in the stock market right now.
But you still have to have that plan in place because that's going to tell you how much in stocks, how much in bonds.
And then you leave it the heck alone.
And then you're going to build the right one. You're going to have it there. So everything is going to be at you, but it's not going to matter.
Everything should always remain invested according to the plan, and the only changes made are changes that are affected by changes in the plan or your lifestyle, in other words, or to rebalance. And we really appreciate the call. Thanks so much for being a part of the show. And please join us every Saturday. Join Tom next Saturday as he does the show alone because I'm going under the proverbial knife.
You'll be fine. We're all going to be thinking about you.
It's not big cuts.
I know, small cuts, but sometimes small cuts can do a lot.
They're going in and they're zapping my heart.
I know. We're looking forward to having you on the other side. And then May 21st, I will be in Portland. If you'd like to meet with me in person, one day in and out of town. Just did this in Arizona. Had a great time. Helped a lot of people. Go to talkingrealmoney.com, click on Meet an Advisor, and I'll do that for anybody, anywhere. But in this case, I'll actually be in our office there. So take advantage of that. TalkingRealMoney.com. And as I said, just click on Meet an Advisor. I think I got that.
And you can also ask us questions there. It's really easy. Just go to TalkingRealMoney.com, contact us, done.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.